when you look at a stock, how do you decide what it's actually worth? You know, it's one of the biggest questions in all of finance. And the answer? Well, it's at the heart of what we call security analysis. Let's break it down.
So let's just dive right in. Every single investor, I don't care if you're a complete beginner or a seasoned pro, you face this exact same decision. Do I buy this thing? Do I sell it? Or do I just hold on? Turns out there's a whole science and maybe a little bit of art behind making that call. Because really, that's the whole game, isn't it? If you can figure out a stock's true value and you see the market is pricing it differently, that's your opportunity. The big challenge, though, is that true value can be a very, very slippery concept. To solve this puzzle, investors have basically developed two major approaches, and I want you to think of them like this. First, you've got the detective, who digs into the cold, hard facts of the business itself. Then you've got the psychologist, who pretty much ignores the business and instead tries to read the mind of the market. Let's start with our detective. The fundamental analyst, our detective, truly believes that every stock has what's called an intrinsic value. So their entire job, really, is to calculate that one number and then compare it to whatever the market price is today. So what is this intrinsic value thing? Think of it as the true underlying value of a company's share. It's based on all the future profits it's expected to make. It's the number you get when you strip away all the market hype, all the daily noise and price swings. And this pretty much sums up the golden rule for a fundamental analyst. It's simple, right? If their calculation says a stock's intrinsic value is, say, $120, but it's selling on the market for $100, that's a flashing green buy signal. But if it's selling for $150, well, it's overpriced, and you should probably sell. Okay, so how do they actually do this investigation? They don't just jump straight into a company's financial reports. Most of them use what's called a top-down method. And it works exactly like a funnel. You start really wide and then get progressively narrower. This whole process is known as the EIC Framework, EIC. First, you look at the entire economy. Then you zoom in on the specific industry that the company is in, and only then, at the very end, do you get to the nitty-gritty of the company itself. So at the widest part of the funnel, you're looking at the big picture, the whole economy. Is it growing, or are we heading into a recession? Is inflation high, eating into everyone's profits? These massive trends are like a tide that can lift or lower all companies, no matter how well they're run. Next, we narrow our focus down to the specific industry. I mean, think about it. Even the best electric car company in the world is going to face challenges if the entire auto industry is in a slump. So you have to ask, is this field growing or is it shrinking? How fierce is the competition? A great company in a terrible industry is always fighting an uphill battle. And finally, we get to the company itself. This is where our detective pulls out the magnifying glass. They're poring over financial statements, looking at things like the price to earnings, or PE ratio, judging the quality of its leadership and asking, does this company have a real sustainable edge over its rivals? All right, let's put the detective's files aside for a minute and meet our other expert, the psychologist. See, technical analysts believe all that fundamental stuff is basically just noise. They think the only thing that really matters is the market's mood, the sentiment itself. Their core belief is that everything you could possibly need to know is already reflected right there in a stock's price chart. They believe that by studying past price movements and trading volumes, they can actually forecast where the price is going to go next. Now, this entire philosophy really rests on three core beliefs. First, the current price already reflects all known information. It's all baked in. Second, prices don't just move randomly. They follow trends. And third, because human psychology doesn't really change, the patterns created by our collective greed and fear will repeat themselves over and over again. So a technical analyst lab isn't a spreadsheet full of earnings reports. No, it's a chart full of lines and bars and patterns with all these strange-sounding names. They aren't looking for business value. They're looking for evidence of fear, greed, and indecision on a massive scale. Let's take one of the most famous patterns, the head and shoulders. The chart literally forms a peak, then an even higher peak, and then a third lower peak. It looks just like a silhouette of a head with two shoulders. To a technical analyst, this is a huge red flag that a rising stock is running out of steam and is probably about to reverse course. And similarly, you've got patterns like the double top. This is where a price hits a high point twice, but it just can't break through. It's kind of like the market is knocking on a door that just won't open, which suggests the price is about to turn back down. And a double bottom is just the opposite of that, a bullish signal. Okay, so we have the detective and we have the psychologist, but what if there's a third theory out there that says they're both wrong? This brings us to a really powerful and honestly pretty controversial idea, the efficient market hypothesis. The central claim of the efficient market hypothesis, or EMH for short, is that the market is just incredibly good at processing information. So good, in fact, that by the time you hear a piece of news, it's already baked into that stock's price. There are no undervalued gems or overpriced duds just waiting for you to find them. Now, this theory actually has 3 different levels. The weak form says that studying past prices is totally useless, which is a direct attack on our psychologist, the technical analyst. The semi-strong form says all public information is already priced in, which undermines our detective, the fundamental analyst. And then there's the strong form, which goes even further and claims that even private insider information is already reflected in the price. So here's the crucial takeaway. If the market really is efficient, then trying to beat the market is, well, a fool's errand. Any success you might have is just dumb luck, because all stocks are always priced correctly based on all the available information at that exact moment. Wow, that's a pretty challenging idea, right? So where does that leave us? Are all these analytical tools just useless? Well, not necessarily. Many successful investors find real value in building a toolkit that actually combines these different perspectives. Here's a really practical way to think about it. Fundamental analysis, all that detective work, is probably best for your long-term decisions. It helps you figure out what company is worth buying. Technical analysis, the psychology part, is often used for short-term timing. It can help you decide when to make your move. You see, one tells you the destination, the other helps you read the traffic on the way there. So there you have it. You've got the methodical detective, you've got the intuitive psychologist, and you have the skeptical academic who says neither one of them can really win. Each of them offers a completely different lens to view the market. So the real question now is, how are you going to combine these tools to shape your own investment philosophy? What kind of investor will you be?